Well, what's up, you guys? Welcome to another incredible episode of the Explain It podcast. We are your hosts. I'm Stephen Hunt.
And I'm Ingryd Hernandez.
Thank you so much for joining us. And if you're tuning into this after the fact, thank you so much for watching this. We have a really cool guest for you guys today, a good personal friend of both Ingryd and I's. And it's talking all things bookkeeping, which is honestly one of the most important parts of our businesses. Ingryd and I are both lucky because, at least on our flips, a lot of the stuff that we've got to do together, my wife manages the most of that. And it takes a very organized person, and you need to have good bookkeepers and people that can keep you in the loop and people to manage those bookkeepers. So we're going to learn all things bookkeeping, which is really exciting, actually, you guys, with our good friend, Oscar Setiawan.
Yeah, Oscar. Well, for the
Oscar.
record, he is my bookkeeper. So I know that you guys utilize different services, which is good. You can get different perspectives. But Oscar has saved my hiney, and we're really excited to have him here. Oscar.
Hey,
welcome,
guys.
welcome. Thank you for joining us.
Thank you for having me.
Awesome.
Oh,
Yeah.
absolutely. So, Oscar, real quickly, before we start getting into all things bookkeeping, nitty gritty, all that good stuff, why don't you give our audience just a little bit of background? Who's Oscar? How did he get involved in this stuff? Does he only do bookkeeping? What's Oscar?
For sure. So I was born in Indonesia. I came to the US when I was about 15, 16, and I graduated as a computer scientist. So I'm pretty much a nerd with numbers and coding and things like that. I worked for a tech company for about 12 years until the entrepreneur kind of side of me. And actually, my mom was always entrepreneur. So we had an opportunity to open a restaurant back in 2012. So we opened pretty much the only Indonesian restaurant in Chicago area. We had that for about 8 years, and COVID happens during that time. And that's when I really pivoted to real estate. I was doing real estate back in 2016, 2017, but it was mostly just as a passive income because my main active income came from the restaurant, right? But imagine losing from $25,000 a month to zero, right? Literally, we have to close overnight, right? So like I had to pivot everything. At that point, I remember I had like 3 projects that was supposed to be rentals, and I just like I have to sell all of these, right? So I literally stopped construction. We had to change some trims because obviously, we have to revise the scope of work if we want to sell it. And at that point, I didn't even know if we can sell anything on the market, right? Because like all the rules, like you can't touch anything. Everything can kill you, right? Anything and everything can kill you, right?
Yeah.
Because COVID back then in January. So I was like, but I have to do something. So I basically went full force with real estate in 2020. And that's really when I also joined Sub 2, right? That's when I met, Ingryd and you and everyone else. So, but that's when I really became overnight a real estate investor full time. I did wholesale, I did flips, and, I had to deal with tenant that's non-paying and all of this stuff, right? Now, at that point, after we move on from 2020, I did a whole lot of, purchase and sell and all this real estate activity, right? 2021 came, and I was going to submit my 2020 tax, and now my CPA is saying like, "Where's your books?" Right now, I just realized that I don't have a book because I was so busy doing all these actions. Right, I'm selling stuff, I'm making money for my family, putting food on the table, trying to survive COVID, trying to take opportunities, whatever happened, and my books is a mess. Right, and I probably spent a good amount of that half a year, 2021, to just find the right bookkeeper, to just try to work with different bookkeepers, but I couldn't really find one that kind of fits my profile because I did a lot of stuff. I wasn't just a landlord. I had so many, maybe 15 something doors. That's already a book by itself. I did a bunch of flips that that was sold, and I have one that's ongoing. I sold a bunch of wholesales, and at that point, I didn't even know like how to categorize or put my assignments versus the purchase price of the property, which is a different thing, right? You have to learn something, right? So I was, it was all these problems in finance, and obviously we want to avoid paying tax where we don't need to, and my books is showing that I made some millions of dollars, which I didn't, because there was bad bookkeeping, right? I'm like, I can't be making this $1 million because I don't have that much money in my bank account, right? So that's when I literally I probably spent about $10,000 trying to find the right bookkeeper, because one bookkeeper kept messing around with my books and say, your books is done. And then it's still wrong. I found another bookkeeper. It's like, your books is done. It's still wrong because the CPA says this balance sheet is wrong. It can't be that much. Right. And so like at the end of the day, I found another bookkeeper, and like instead of having him do it, I taught him all things real estate. Like literally I came in and was like, this is what everything is. Every single thing that I did in 2020, I had to tell him, like literally kind of breaking down all different deals, showing all the huts and everything. And that's kind of like how the
You
bookkeeping
learned.
started
Yeah.
by accident. Like I didn't want to create a bookkeeping firm, but it was just out of my need because I couldn't find a good
That
one. And
sounds
maybe
That's a
familiar.
very common theme that we hear on
yeah,
this podcast, Oscar. It's like everybody that has a business now doing these things, they go, everyone else sucked, so I needed to do it myself.
right.
That's
Yeah, if you're a
awesome.
visionary, if you're very driven, you'd be like, I'll just figure it out myself, right?
Yeah.
It just I already spent this much, right? Might as well figure it out myself to do it right? So, so when I had my books and my CPA said, yeah, you good, your book is good now, and with the community that we have, whenever I network, the same questions comes up, right, dude? Who's your bookkeeper? Who's your, how do you keep your finance? Like, I don't know what I'm making. Like, I'm taking home this, but then the next day it's out, right? So you keep hearing the same thing again and again, and that's when the beginning of this is I'm just trying to help people, right? So the first few people that we had as a client was just literally trying to help them, right? It was not to create a business, because at that point we have bandwidth to help other people. But from 1 to 2 to 3 to 4 to 5, and I'm like, well, this could be turning into a nice vertical integration to all of the business I have at that point, right? Because we still need to do bookkeeping. So I have a companies that will hire the bookkeeper to do stuff, and now I'm creating a vertical another business to just so that everything will integrate well, right? And so now moving fast forward, now we have a few team members both in the US and in the Philippines to grow the business. We put a system and processes, so now I'm free to do more things in real estate and then have the business running, right? And we're still helping people and more people in terms of even real estate. And the interesting thing is that when the business grows, when people know you and you're doing a good job and you're dedicated to help people, they will give you other businesses. So interestingly, not only real estate, but now we're taking care of all, like a dental business, for example, because it's the client is actually a dentist and he owns real estate portfolio, for example.
Oh dang, a
right?
built-in PML, Oscar.
Exactly, right? So it's very, very interesting on how when you want to help people and you dedicated to help people, like things will open up and you get new connection, new network, and the business will grow organically, right? To because you do want to help people and in terms of finance and everything, right? So now as we grow, we're start becoming an advisors for people, right? And because of my background in real estate and me getting better, and because I wasn't good in finance, maybe like back in even 2012 when I ran the restaurant, right? I was able to do the books, but it's not like anything really what we do right now, right? It was just inventory in and out. But with the real estate, it's so dynamic and there's so many strategies you can employ to save taxes, the deduction, the cost segregation, and everything that you learn the last few years, add to my skill set, right? In terms of investing and now finance. So we're focusing on growing that business, becoming a fractional CFO, becoming a business advisor, trying to put the right system and process to businesses growing. That's just the same thing as we grew, right? So that's kind of like what we do right now.
I love it. I love it. And I am very, very lucky that I crossed paths with you. Little vulnerable story. So I was really behind on my tax stuff. And we were at
a little.
We were at oh gosh, what why can't I think of Bigger Pockets? My God.
Bigger Pockets, yeah.
And Oscar he hunted me down and he was like, we need to finish your books. And I'm like, okay. So we took off and I was in his room for like, I don't know, 2 hours or something, like just trying to finish up. Like what's really tough is like when you're trying to build a business and go, it's the administrative things that I think are where you fumble.
Oh, totally.
And
I love surrounding myself with like A type personalities, like an Oscar who says, we need to finish your books.
Yeah, yeah.
Or, you know what I mean? Or lenders that reach out to me, they go, we need to have these documents, and they're
Yeah,
texting you, and they're the ones that are in front of
Yeah.
you,
Mhm.
pushing that because it's true.
Yeah.
People like us, and I'm sure like you too, Oscar, it's like you're constantly go, go, go. I want to grow the business. I want
Yeah.
growth,
Yeah.
growth, growth. You're like, this other stuff back here. No, I don't.
So Oscar, good
Yeah.
news. Tomorrow, my sister is going to come in, and I'm officially hiring her as my assistant so that I can
Oh,
keep
okay.
up with all the stuff, mortgage
Amazing.
statements, the uncategorized crap. But I did
Okay.
finish my categorization. Just
Okay.
let David know.
Yeah.
So
That's
but
the thing that
anyway,
we like to hear from our clients, because
yeah,
that's really the constant challenges, right?
Mhm.
yeah.
How long did it take you, Oscar, to get to where you're at right now with the bookkeeping business? Because
Mhm.
I think all of us know when you start a business, it's not an automated, business that has all the SOPs, has all the KPIs. How long did it
Mhm.
take for you to get the business going? I'm sure you had to pivot 20 million times, and I'd love to break that
Yep.
down too. But to a
Yeah.
point where you go, cool, I can step away because you said earlier that you get to focus more on your real estate stuff again, which is so awesome.
Mhm.
How long did that
Mhm.
take you?
It took us basically a year to really set up, to know what we're doing. Basically, it's not even setting up the system and process, like to know how to put things into places, how to really gain that skill set to become a real estate bookkeeper, right? Learning from mistakes, learning from our clients to their behaviors and things like that. Learning from Ingryd books, right? Just the way she wants to do it, and the way her deals and everything, because every deal is slightly different, especially when you talk about creative finance, right?
Mhm.
So
Mhm.
it took us about a year, probably a little bit more than a year, before we actually hire another person, because at that point we're like, okay, we have enough
Data points.
documentations
Mhm.
that we wrote down, and all these Zooms that we recorded, to be able to pass this on to someone else to learn, right? But in the beginning, it was literally the first year, it was just me and the bookkeeper, right? Meeting
Mhm.
every single day, learning from our clients, creating a to-do list, building what we call a fulfillment department, right? In this business, so that eventually we can grow and we can help the bookkeeper becoming the leader, right, in that department. So then, after we create that foundation, I can move, quote unquote, to a different department, right?
Yeah.
And that's part of the business building, right? That's part of following a business framework, in a sense, where all of the business has a few departments, like say finance, operations, and marketing and sales, for example,
Mhm.
right? The first thing that we did was we strengthened the operations, right? We want to know the operations. We want to know that we can fulfill, because I'm pretty good at sales, right? I can sell, but then what about the fulfillment, right? That's something that we had to really do well on the first year where we grow, right? And
Yeah.
that was when I didn't even care about the profit that we make, because everything we have is reinvested into buying courses, learning under mentorship about finances and bookkeeping and all of this stuff that we can make better, right? System and processes, right?
Yeah.
But
Yeah.
it shows, because after the first year, we're able to hire the right, what we call the right team member, the right people in the right seat, right? So that when they come in, they have the right behavior, they have the right skill set, so they just can take off with the SOPs that we have.
Yeah.
Right? So
Love that. I love that you started with operations first, because I can tell you right now, I did it the exact opposite that you did it when it came to my
Yeah.
own businesses, as it was sales, marketing, drive it, drive it, drive it. And then all of a
Mhm.
sudden you look back and you go, cool, I drove all this business. Shit, fulfillment is falling through the
Yeah.
cracks now. We got to make sure that we're going back now and, playing catch up to make sure that
Yep.
everybody can be managed appropriately and all the things can be done right. You said, hey, let me lay the right foundation to begin with. And
Mhm.
then I know that we can expedite framing it all out. Then I know we can expedite making sure that we can build the house as quickly as possible, basically, once we have the
Mhm.
foundation set. Whereas
Yeah.
a lot of us, right, especially visionary type people like me and Ingryd as well, where we
Mhm.
were like, I just want to do it. I just want to make it happen. I just want to go. I think
Yeah.
that's really, really awesome and such a valuable lesson for a lot of people here to learn. Not using
Yeah.
the operations as a way to delay yourself and to not take action. You were clearly taking action the entire way through, but making sure
Mhm.
that you had a strong fulfillment. So it was something you were proud to sell, is what it sounds like to me.
Yeah.
I was gonna say not
Yeah, I
everyone.
think so.
Yeah, I recognize though not everyone has that privilege, right? Where you probably had, your financial footing where you could go slow to go fast is what we used to say in the corporate world, right? Like, let's go slow, make sure we're getting the right footing, the right SOPs, documentation. It's really interesting. So I flipped into entrepreneur world and I became more of a visionary, but my whole adult corporate life has been an integrator. Always.
Interesting. Yeah.
So, but I still remember where I was like, that happened so slow. All of my career growth happened so slow because everything was so methodical that I was like, I can't do that in entrepreneur world. I won't survive. So I think there's a balance behind like how much chaos can you create, but can you partner with the right people who will help you stay in line? I think that that's really the key piece.
I agree.
Yeah.
Totally.
Yeah. Cool. Well, Garrett has a question, and I feel like with bookkeeping and CPAs, things can get pretty blurred. Although I will say, I remember you schooling me once that you can actually do tax returns and not have a CPA license. You can be an EA. Is that right?
Yes. Yeah. It's called enrolled agents, which is certified and by the IRS. Right.
Okay.
So having a CPA license is great because now you can defend and you can go to the court and you have a license that you can kind of practice to defend
credibility and you have
credibility
more
and things like
rights,
that, right? And in some cases though, we just ran into this. In some cases though, when you have to perform an audit in certain scale, they do request for a CPA designation, but just for the filing federal and state taxes, you just need to be an EA, an enrolled agent with the IRS. Yeah, to officially be able to file taxes for others.
Very interesting. I didn't know about that.
It's how H&R Block gets their people.
That makes a lot of sense. I actually did not know that.
Yeah,
if I could put this into a term that makes sense to me, it might make sense to somebody else that's not, familiar with CPAs, EAs, all this kind of stuff. It'd kind of be like having a medical doctor, right? An MD. And then the MD hires out PAs, physicians, assistants. They can't do surgeries. They can't do a lot of the bigger stuff, but they can still prescribe. They can still see patients. They can still, do all that kind of stuff. But the bigger stuff, when it gets to surgeries and that stuff, it goes over to the MD. So it's similar when it comes to a CPA and an EA. It's what it sounds like.
That's a good analogy.
Yeah, pretty much. Yeah, good analogy. Yeah.
Okay, so this question comes to us from our good friend Garrett. He's a painter.
What's up, Garrett?
I met Garrett after a wholesale event with Brent. Can I think of Brent's last name right now?
Daniels.
Thank you. And he was great. So young kid doing his thing. He's a painter and he's made a lot of money. Ladies, he's made a lot of money.
There you go.
But now he needs to offset those taxes. So obviously this is not advice, guys. This is valuetainment on this YouTube. But like, is there any feedback you can give him that he can go and ask his CPA or his tax?
For sure.
people?
Yeah,
Okay.
we get these questions a lot, right? And again, we're not CPAs. We don't at this point.
I'm a real estate license, so I'm like,
yeah.
I'm not a whatever.
Yeah.
It's always right here, ready to go.
Exactly. So there's with everything, the answer is always it depends, right? Now I can explain the it depends part because we've been through it and we've asked CPA about this. So throughout the discussion, we know the answers. But again, to be safe, you have to ask your CPA or tax professional, right? So the depreciation from sub-2 and seller finance rental can offset your taxes for your main income business. Basically, your painting business is an active income, while by default, your rentals is passive income, right? That's where the difference is when you're filing tax return, the Schedule C or the Schedule E, right? The one that can help you move your losses from passive to active is if you can qualify as reps, which is real estate professional status, right? And that is basically proving that you are working, and I believe the number is like more than 750 hours in managing the real estate.
Yeah.
Right. So typically when you manage your real estate yourself, you go to the rehab, you go to the Home Depot, you buy the stuff, and you manage your all these hours that you spend, right, in real estate, managing your rentals and all the areas activity can qualify as reps, which is really up to your CPA to now qualify, right? If your CPA is good, they will give you this sheets. It's called reps tracking sheet. And technically you need to fill this out, because when they are audited, it's their responsibility to defend you, right? Your CPA will take the liability to defend you because they qualify you as reps. And this is where it depends part, right?
Yeah.
Can your CPA qualify you as reps? If the CPA can qualify you as rep because your activity, once you fill it up, 750 hours, right? That's what it is, right? But again, your main income is active income, right? Your rental is passive income, regardless if you're a painter, I know, but that's still a service business, even though it's in real estate.
Yeah.
Right. Now, technically, yes, you can definitely be qualified as a reps, but then that's a conversation that you need with your CPA, which is why they will give you these sheets for you to fill out. Let's say you go from A to B for how many hours, and B to C for how many hours, doing your rentals and obtaining properties and things like that, right? That's why it's very easy for real estate broker, for example, right? Someone like you, Steven, that owns a fix and flip company, right? And that owns rental too, because that means you are doing both activities, then you can qualify as reps.
Yeah. Yeah, I think we easily qualify now,
Easily.
especially when you have like a license in real estate and no W-2. So my husband got his W-2 in 2017. So we've been able to claim somebody in our household income as a rep since then.
Yep.
So I didn't even know it was a good strategy. That's why a lot of couples actually strategize. If they have a homemaker, I'll say, or somebody who stays at home, they go and get a license, and that's a way to kind of let's say I have a license and I don't have other sources of income. Do I still need to track my 750 hours?
Technically, yes. However, it usually when you don't have a W-2, and you can prove that you own rentals, and you depreciate on those rentals. There's a schedule of depreciation, the table that you submit every time to IRS. That usually means that you're doing a lot of things with the real estate, right?
Really.
But like I said, when you get audited, when the IRS asks for proof, the tracking sheets will be the one that you need to show, right?
Yeah.
Now, regarding Garrett, right? He said painting is my main income. And if that's, you don't have a W-2, meaning you don't work for someone else in a corporate job, then yes, I do believe when you talk to the right CPA, he or she will be able to qualify as reps, and then you can offset all your active income from your rental activities.
Yeah. If let's say somebody cannot qualify as a rep, but they have rentals, and they, we're often touted, if you have like a high paying W-2 and you own some rentals, help offset your taxes. Is there still an option to depreciate even though you're not qualified as a rep?
So depreciation will always happen, right? Depreciation always will happen. What you're talking about is if you want to offset more of your tax responsibility from the passive income, right? Now, the number one thing that is a buzz right now with everyone, that especially someone who's a high paying or high earner W-2, is STR loophole, right? That's why there's a boom in buying turnkey properties, in buying, somewhere where there's a vacation place, where, a cabin or things like that, right? And they usually buy turnkey, right? 20% down, turnkey, or subject to creative, but putting money down, and they don't mind the money being stuck in there, right? Because at the end of the day, they know that's an investment for them that can write off. It will pass through with the STR loophole if they did certain type of activity that would qualify them for that loophole, right?
Yeah.
So there's still requirements. For example, you still have to spend this many hours. You still have to do this. The STR has to qualify as a property that is rented on average 7 or less days. So there's a lot of requirements. However, if you can prove that, then you can offset your active income through this STR loophole right, from the passive activity that for the STR or Airbnb generates.
Yeah. Yeah.
Yeah.
Okay.
Yeah.
So I'm a W-2 person. Let's say I don't have the STR loophole, but you're saying I can still depreciate my property. I just can't do it at like, I can't like do bonus depreciation, right? Or
So it would be, so bonus depreciation is probably when cost aggregation comes into play, right? So
right.
that's probably a number two way to reduce your tax liability,
Yeah.
right? Because now you can force this bonus depreciation in the beginning, in the first year, right? Versus depreciating to like 27 years and a half, or 39 years, or 5 years, or 7 years, depending on if it's
Yeah. By the way, I
appliances or
didn't
things like
know
that.
that short-term rentals are depreciated at a different scale
Yeah,
than
it
Yeah,
bonus.
is.
yeah, it's
I
wild.
I didn't know that. Yeah.
Yeah, yeah, and then it's something that we learn too, because we work with a lot of different CPAs, and some CPA doesn't even do it, to be
Yeah.
honest. Like,
If you're
and
in
we're
the
like,
audience, guess how many years you get as a short-term rental to depreciate versus a long-term rental. I'd like to see what you guys have in the comments. Like,
yeah,
if you don't know, I would love this too, because I genuinely thought it was 27 and a half, just like everything else, and it's not. So
yeah.
anyway.
Yeah. So can you also break down a little bit the STR loophole that was brought up and mentioned there? Because there's a lot of friends that I do have that are high income earners, but it's nothing involved in real estate whatsoever, whether it's their own business, whatever the case may be, and they look to dump cash once in a while, like you mentioned, these turnkey properties, all that kind of stuff. So I'm just curious on that side of it, what that would look like for them, so that way I can just be like, hey, just go watch this video with Oscar.
Well, it's everything. A lot of things here is always available on YouTube University, right? But that's where things get iffy, because like you don't know if it's right or wrong, right? So getting with an experienced tax advisor, getting with an experienced like bookkeeping and also business advisory that can help you with tax strategy and tax planning is very important, right? Especially someone who are in real estate like us, that has clients and has has done with this type of deal with their actual clients, right? So otherwise you just kind of be reading, because right now you can ask ChatGPT, and you can ask ChatGPT on two different ways, and they'll give you two different answers.
Yeah.
Right? I bet you if you word it, if you try to trick ChatGPT, you'll be able to trick ChatGPT to say it's not 39 years, which is the right answer, right? The 39 years.
Yeah.
I bet you can trick ChatGPT to say it's both 27 and a half.
Yeah. Yeah.
Right. So that's why it's kind of a little bit at this point our advice is very much everything it depends.
Yeah. Yeah.
Right? Because the tax code is very complex. The burden of proof is upon us to show that you are reps, you are involved in your STR, and you can prove that because you are involved, then you can pass on the passive loss as an active loss to your W-2. Right.
So Garrett, one thing that you do have to be aware, and one of the key things that Oscar mentioned, is that the short-term rental is turnkey, and I think another important piece is that it's in service. So if you're trying to do it for this year and it's not currently in service, I don't know, at least this is what happened with me with my CPA. They will not take it even in that calendar year. They'll take it in the actual calendar year that it goes in service. That's something else I learned the hard way. And I was like, what the heck? Then why did we push so hard to close on this property on the by the 31st?
Yeah.
Right.
And you know how I learned that is when in 2021, right? When I start having all of these tax and bookkeeping issues, right? So it's very important when you put that into service, right? If you're doing long-term rental, even when that back then I did more long-term rental than short-term rental. Even so the trick that we did was, even when the property's not ready yet, it is 90% ready, we can already advertise it.
Yes.
And when we advertise it, it means that it's already in service.
Correct.
Yeah. So now going into STR, even if it's not done, even you still kind of doing last minute thing and everything, and it's the end of the year, you could technically put it on Airbnb.
Yeah.
Right. And then, that technically can qualify as in service. Now, I don't know if that's additional rule to say, you need to have it book for 1 day occupancy or 2 days occupancy. But hey, we're creative, right? We can always have our family stay there.
Yeah.
Right.
Cousin, come stay
And
at my house for
that's
2
not a
days.
legal advice, okay? That's a
Yeah.
creative
Yeah. Yeah.
thing
Yeah.
that, and I don't want people to come back. It's like, you just gave me an advice and I'm in trouble now, right? Because
Yeah.
Yes.
This is entertainment. You take it as
this
you
is
will.
entertainment. But it's interesting what you can do to certify that it's in service.
Yeah.
Yeah, there's definitely ways to work around some of those things, like you said, not tax or legal advice.
Mhm.
I am curious. Here's a question that I get all the time, Oscar, and I actually tell people I'm not a professional. Don't ask me. Ask a professional.
I always say my unprofessional
Yeah,
opinion.
I'm like,
Yeah.
I don't know. I'm like, I don't do that, so it doesn't sound. I don't know. But I have people that also reach out to me and they go, "Hey, I'm going to buy this house and I'm going to lease it to myself. I'm going to have my company lease it to myself so I can
Mhm.
get the write off." Is that something that is feasible? Can you hold a property in your LLC and lease it to yourself and get that full write off?
Yeah. The short answer is no. Right.
That's
And
what I thought.
that's basically like black and white there. Right.
Yeah.
Now,
I also
we've
heard about phantom income or something around that.
yeah, because at the end of the day, if you look at the word, so IRS cares where the money flows, right? So, for example, if you own an LLC that would rent it back to you, right? The LLC would take the money. Let's just say hello, hello.
Hello, hello. Can you hear us?
Yeah. So I
I
don't
have
know
no
what.
idea what happened there.
Yeah. So, but anyway, I don't know where you lost me, but let's just say you pay rent to the LLC, right? You pay like $2,000 rent. You write a lease from one LLC that you own to yourself, and you pay $2,000, right? So that $2,000 goes to the LLC, but regardless if the LLC is passed through, that revenue minus expense and everything goes back to you anyway. Right. So the
Gotcha.
IRS will see it anyway that at the end of the day, you're responsible for that income. So now you're just telling yourself, right? So imagine this. Stephen rents from Stephen LLC. Stephen rental cannot be expense because Stephen is a person, not an LLC.
Mhm.
So Stephen cost of living is that rental, right? Stephen LLC received a revenue of $2,000 minus expenses and everything. Let's say $1,000. So now I think you're just shooting yourself in the foot because now you're just saying that Stephen LLC made $1,000 of someone. It doesn't matter if
Mhm.
it's Stephen, someone. So you basically have to report that as an income.
So
At
it's
the end
like
of
double
the day,
income.
you just declaring Stephen LLC if it's a pass through. Stephen LLC just made $1,000, which passed through to your tax burden. Now Stephen owes $1,000 to the IRS, not $1,000,
Gotcha.
whatever the tax bracket is. You know what I mean?
Yeah.
So that's how it doesn't make sense.
No,
Right?
it
If
never made sense to me
follow
either.
the
And I always told people
numbers, yeah,
probably
it
not.
doesn't make sense. Yeah.
Yeah.
And I was like, but I don't know officially. Maybe there is a loophole.
Mhm.
So that's why I was like, I'm gonna ask Oscar. Oscar
Yeah.
probably knows the answer to
Yeah.
this because I always tell
Mhm.
everybody no.
Yeah.
Right.
I think
Now, there's a difference if you have an LLC that is a property management or that owns the property, and you have another company that needs an office, for example. Right. Again, at the end of the day, where does money flow?
Yeah.
Right. The money goes through. If it's an S corp, then that company will file their own tax return. But if it's a partnership or if it's a pass through, it's gonna go to the owners at the end anyway.
Mhm.
Yeah.
Right? So you're just declaring income somewhere, and you might be actually paying more of tax because you just kind of move money around. This phantom money just move around
Yeah.
intercompany, and then it goes back to you more than what you would spend.
Right.
The only place I've seen this work so far is with actually the Manor, our property in Gilbert,
Mhm.
where we have a completely different company running the property, like from a property management standpoint, because we actually have different folks sleeping in different rooms
Yeah,
and renting,
that makes sense.
but not necessarily as a single. And like Marlon, he pays rent, right? Because
Yeah.
he lives in there, but he's paying that rent to a different LLC versus where he's collecting it.
Gotcha.
Yeah.
Right.
Gotcha.
But
Yeah.
it's
Yeah, similar to
convoluted
my
enough.
example, right? So yeah.
Yeah.
Yeah, for sure. Cool. Well, guys, if you're getting value from this, don't forget to hit subscribe and like, so that we can continue doing these really cool podcasts with cool people like Oscar. Really appreciate everything you said so far, Oscar. And so tell us, because you're in the space full of crazy people like myself and Steven, is there an anonymous story that you can tell us where it's like the craziest thing you were able to do, or help or something like that you could share with us to kind of put some light, other than the fact that you sequestered me for 2 hours to get my bookkeeping done?
Yeah. There's a lot of very unique, I would say probably very unique challenges that we face, right? In terms, especially with creative finance. I think one of the most challenging problems that we had, that we have to spend maybe close to 2 hours just brainstorming with the CPA, was a wrap story. So one of our clients, she bought a property subject to, and then wrap it to a buyer. So basically creating the note, right? 6 months later, foreclose on it. So she had to take it back in foreclosure, deed in lieu, right? But it was foreclosed, and she get the deed in lieu, and turn around and flip the property. So now within that 1 year, there's multiple instances where the deed changed hands.
Wow.
When the deed
Wow.
changed hands to different people, well, there's tax consequence,
Yes.
right? So when you bought it sub to, there's a tax consequence there.
Well, taxable
which is
event. I wouldn't say
a taxable, taxable
yeah.
event, right? From there, when you sell it to the rep buyer, it's a taxable event too. But you're able to delay the gains because it's unrealized and all of the stuff you can do, right? But what happened when you take it back? Right? Because now you're taking back a property, your note defaulted, and you lost all that values, right? Even though you already have now a realized deposit, for example, right? But the thing that we care about is, at the end of the day, when he purchased it until she sold it as a flip, is that a realized gain or a realized loss? So that was the one that we had struggled with.
Yeah.
You know what I mean?
I feel like you have to whiteboard that one out. You're like, okay, here's
we had to, and we had to have a 3-way conversation with the CPA, and the CPA was like, "Oh my God," or like, because we have to really break it down, right? Because at the end of the day, it's credit and debit.
Yes.
Right? Everything, when you look at the master statement,
Ones and zeros.
this is why it's very, very important for us to ask for a master statement, right? Because at the end of the day, we can justify the deduction, expenses, gain, loss by the debit and credit of the master statement. That is, we can journal entry in your books.
Yeah.
Right? Yeah. So,
Oscar, I'm
but
selling.
that was one of the most interesting part. We had helped people who are in bankruptcy that had to go to court, and the court needed the entire financial report to justify, if they're going to erase the bankruptcy, how they're going to proceed the bankruptcy based on the assets, right? So we had to help the team with like, okay, well, this one over here in this LLC, and this LLC is involved in the bankruptcy, that one's not involved, so we have to remove that asset from the balance sheet so that it doesn't be involved in, what I mean, like those stuff that you need to just have a clear balance sheet, which a lot of times people don't have, and that's where people get in trouble, because they don't know their liabilities, they don't know their asset, where it's supposed to go, and their net worth at the end, and that's where people get stuck when they are asking for, let's say, unsecured line of credits, or they face a legal battle, right? And you're like, oh, where's your balance sheet? Well, I don't have a balance sheet. Okay, so we're going to take everything that you have now.
Yeah. I think the one that's become a little tough for me because of the LLCs that I do have is where one LLC does intercompany to another. So that's probably my biggest challenge right now. When you talk to bookkeepers, actually not bookkeepers, clients, what is one of the biggest challenges that they bring to you that you're maybe seeing on repeat that you're constantly answering?
Yeah, so it's literally what you just said. It's intercompany loans, right? Or
Yeah.
capital contributions from the owner to another LLC, and then
Yeah.
that LLC also have a partnership, and they transfer that money into the different partnership, hoping that sometime it would get, it would get paid back, but then there's no mechanism to keep track, right? So
Hmm.
this is the biggest challenge for us when we try to construct their books, right? When we get
Yeah.
trying to construct their balance sheet, right?
Hmm.
Because we want to make sure at one point, if anything happens to this LLC, if the LLC has to be liquidated, if the LLC was to be sold, if something happened to the LLC, regardless if there's a partner or not, you know how much you owe to, right?
Yeah.
You know how much you owe another company, even though the company belongs to you, or even the company belongs to your, you and your partner,
Trust or yeah.
right? If you want to sell your shares or you want to sell your equity to your partner, you need to be paid back your contribution,
Hmm.
right? So that's when things get a little bit iffy, because now at that point they don't know, right? And at that point the situations becomes like, well, I think you owe $5,000. Well, no, I think it's $10,000. Where's the receipts? And all you see is like a bunch of deposits,
Yeah. Yeah.
right?
That
So
makes a
yeah,
lot of
but
sense.
that's something that we help people, and I think we help you too, to say, to clarify, well, Ingrid, you made a contribution to this LLC. It's okay that you don't give it back for now, but just to let you know, you had this much money from this LLC, that at one point, if anything happen, if any of the structure happens, if you become an S corp and you take on partners, you take on shareholder, whatever, they need to know that you've put in this much money into it, and you need to be compensated, or there needs to be more, like, say, stocks goes to you, and all of those stuff, right?
Yeah, and that makes sense because
Yeah.
it's also a part of your valuation. At the end of the day,
Mhm.
you're building a
Yeah.
company. So what kind of debt do you have against that
Mhm.
company, even
Yeah.
if you were the one contributing to that company? So that makes
Yeah.
a whole
Yeah.
lot of sense.
Yeah.
Very cool.
And you'll
Very
be
cool.
Very
surprised how much
interesting.
money you put into your business, right? That's also needs to get a financial clarity, because now at that point you have to say, you know what, I need to, shift my strategy, so I don't need to put in more contribution, because I put in so much contribution. And sometimes they get lost, right, when you're building a company,
Yeah.
right? You
Yeah.
just basically, and this happens to me in my very first year, right? I keep putting money from my personal into the company, and the company makes money, and then I pay myself back. But at the same time, the company still need operation, so then I'm going back and putting back in, right?
Yeah.
So
I
that's where
feel
you
that
find
pain.
a clarity. Yeah, so it's just money
And
just revolving around, right? And
Mhm.
there's no clarity of like how much I need to get paid from the LLC, so I don't need to get this cycle of money in, money out, and
Yeah.
just clarity, like, I want to take home this much, and the company needs to survive to make enough money, so I don't keep putting the money that I earn from the company back into the capital contribution.
Yeah. Very
beautiful.
And
So
all
I
of
do
us
have
have done
another.
that.
I have another question too, tax related here, that I think doesn't really get talked about too much in the real estate world. We all love to talk about the pros of getting your depreciation, all this fun stuff. Now, when
Mhm.
it comes time to sell your rentals, and let's say somebody does not want to do a 1031 exchange and kick that can down the road, they just want to sell it and they want to take that cash and move
Mhm.
on with their life because they're over it. They hate their rentals.
Yeah.
Um, what does depreciation recapture look like for those individuals?
Yeah.
It
Well,
depends.
basically, once you sell, once you sell the rental, right, everything that you depreciate needs to be put it back in when you do your final tally of the capital gain, right, or your whatever your income is from there, right? So that's where it's very important to get either usually when you file tax, the CPA will have a depreciation table, right, and we'll go off that. So basically, if you like, I've done that multiple times, because I've owned rentals at this point for like 7-8 years, right? And I've
Mhm.
sold some where I can capture back the what we call a return of equity, right? Because I gained so much equity that I can sell that for triple, right? I bought it for $80,000, fix it up, and now I can sell it for like 7 years later for 280, right?
Yeah.
So, but with that also, I have to pay back all the depreciation, right, that I've captured for the last 7 years. So that's where it's very important to keep track of that in the balance sheet, right? Which is what
Gotcha.
we always do. Yeah. So we
Yeah.
we go base it off of the CPA. And we can calculate ourselves because it's basically 27 and a half, right? But in the middle, throughout the way, you probably did some capital expenditures too, right?
Yeah,
You might change the roof,
that.
and that costs you
Yeah, yeah.
$10,000.
Yeah.
And that add to the capex, and that add to the depreciation table,
Yeah.
right? So that's where we will work with the CPA to make sure that we have the right depreciation that you need to recapture and give back, right?
Okay, here's your warning. I'm selling one of my rentals, and I'll need to do that. So that's so funny. Yeah.
Which one are you
It's
selling?
not a big
Texas?
deal, you know,
I'm
if
selling
you
Houston. Yeah.
Okay, you're selling where?
I'm selling the Houston property, the 2.25 interest rate.
Oh,
I was
okay.
gonna list it in April, but I found an investor out of Texas who's like, wait, is this an active short-term rental? If I give you this much money, will you just keep the furnishings in it? I'm like, yeah, that's fine.
Mhm.
So I think he's getting a sweet deal. I think I'm getting
Nice.
a convenience deal, you know, like, hey.
Mhm.
And so what I'm doing is I'm selling my sub two.
Sure.
So and we're still trying to figure that piece out. I wrote out the
Yeah.
contract actually last night, normal, right? But
Mhm.
I think the part where I want to make sure is that I'm actually clear of that trail. And creative can get confusing because if I sell it sub two, technically I get a deed of trust and promissory note. And so I'm trying to figure out, should this actually be a sub two or should I just be assigning my rights? So I wrote it like a sub two contract just in case. And then we're waiting for, and you may know him, Caleb Christopher, to kind of give us advice about like what's the right approach about closing it. Cause we're having to self-perform on it anyway, in order to hit that end of year deadline. So
Sure. Yeah. So,
Nice.
but you're not doing a contract for deed. You're
no, this
conveying
is in
the.
Texas. You can't even do a contract.
Oh
for
yeah,
deed
that's
in
right.
Texas.
Yeah.
Yeah. So,
Okay.
yeah.
So,
But he's excited.
well.
He gets his short-term rental. He's made a crap ton of money on e-com this year. So he's going to bonus depreciate and again, get a 2.25 interest rate. The property performs. It's just it's such a hassle for me in Houston, being so far away. I know you know this, right? You have property in Florida. But at some point it becomes more of a distraction for me because I don't have like a team set around it, and I have some other obligations that I have to commit to with that cash. So
for sure, and it's good to kind of like, you know, just remove the distraction, you know, to just focus on building one thing at a time. So,
and guys, this is why I think, and maybe you can chime in because I think you're on the same page with me. Like, even when you're going to go buy sub two contracts or buy any property, whether it's a BRRRR method or a sub two, I would say always lean on the side of having equity. The reason I have this option is because I bought a property below the potential ARV. And, you know, now that I'm in a place where I have to kind of, you know, restructure my debts in some regard, like it's nice to have had this option. And I wasn't like stressed or like anxious about this because I had it as an option. And so for anybody out there buying like little to no equity houses, like if that makes up a good portion of your portfolio, like I'm praying for you.
I hope you have a really strong source of active income. I hope you have 7 figures in affiliates coming in every single month. You know what I mean? So that way you can afford to lose on those for the write-off purposes.
Right. And not to say we're not. I mean, we've gotten a little risky on a couple of the deals that we bought together, myself and Steven, but they were strategic and they're in locations where we're like, you know, it feels like a can't lose location.
High appreciation,
right?
Lots of people out because
Lots
of convenience.
activity.
Exactly. They're good markets to own rentals in.
Yeah, one that we definitely bought underwater, but we went with it eyes wide open, and we had like I already had a box, like a room full of furniture, you know, and that sort of thing, where like it was an easy yes because of all the points that put together, but like. All to say though, that makes a very small portion of my portfolio. Like your portfolio, in my opinion, should be the tried and true investment approach, which is go get yourself equity because you never know when you need to flip that switch and have it serve you. Even Pace, right? Like when he had that guy who, I don't know, like Pace. I'm speaking about Pace Morby because he was one of our mentors. It's like had he not had his package of like 45 or 50 rentals that he was able to quickly sell and dig himself out of that hole that he was put in by somebody else, he may not be singing the same songs he's singing today.
Correct.
Because those saved him. His rentals saved him because they had equity. And I would say, same thing to all of you out there is like, please, please, please don't forget some of those fundamentals, because I hear a lot of low to no equity stuff, and it makes me cringe just a little if you don't understand the bigger picture and context.
Right. Yeah.
What are you truly trying to accomplish?
Yeah. And that's the thing that's very important for us to have a good book, right? Regardless if you have a bookkeeper or not, because those information can be found in your balance sheet.
Absolutely.
Right? Your balance sheet is not profit and loss. It's not how much you made. It's not how much you lost. It's really your assets minus liability, right?
Yep.
And guess what? If you keep track of your sub two properly, then you'll see right away what is your net worth. And just be careful when your net worth is almost zero, even though you own this asset, right? It doesn't mean anything because now you're over leveraged.
Yeah.
Right. So, there should be certain type of formula. There should be certain type of reserve that you have. And what you said, active income.
Yeah.
So that anything that happens, you're able to cover it up, and enough diversification where you do have properties that has a large enough equity that can cover all of these. Again, these are diversification that we need to make, but we can't know until we have a good financial report that we can see, whenever we want to make this decision.
Yeah. By the way, one of my fondest memories was Oscar in my entrepreneurial experience. My 2022 year, where Oscar's like, "Do you want to see your balance sheet?" But he was like, I'm like, why is he telling it to me like maybe this is good news? Like, what's happening here? And this was like right after we had learned that I think it was like 92% of business owners and operators don't hit the $1 million mark. And that year I hit the $1 million mark, but he's like, but that's just your vanity number. So it came with like, cool, I hit that number that from a revenue standpoint, but like, here's the real number, Ingryd. I'm like, and he's like, Ingryd. And this is why I do business with Oscar. And I would encourage any of you to consider Oscar for your bookkeeping, because he's like, but now our job is to help you see about how we make that gross profit that you hit at the end grow. Right.
Yes.
Like, what is that? Excuse me, not gross profit, net profit grow. So ever since then, it's always been chiseled in my brain that when somebody tells you like, oh, we made 7 figures and this, that, and the other, it's like, okay, but tell me how much did you keep?
Yeah. What did you take home?
Yeah. Yes. And your bookkeeper will keep you straight on that. Like, again, Oscar was very sweet. Like, hey, here's your number. And I was super excited.
It feels good.
It does feel good. It's still a milestone.
Yeah. It is an accomplishment, right? To be able to generate that much revenue with your hard work and everything. But now you need to understand the work just begun. Right. And then now you need to optimize your operation. This is where we talk about system and process, hiring the right people, plugging out the leaks, right? Like, where do you have leaks? Are you optimizing your crews, your resources? And we still have these issues too. We're still trying to optimize the performance of our team members, right? This is the next issues in my company that we face. Now, as we grow, do we hire more people or do we optimize the current system and process so that with system and process, I rather increase their bonus and salary with increased performance versus just hiring another people just because we need another body. I learned that the hard way, right? And some of you probably learned that the hard way too, right? But we know that it's the answer's not always hiring more people.
Yeah.
Right? The answer is like, let's look at the leak. Are we performing well? What are the things that we can optimize first? This is why people say, hire slow, fire fast. All right. We got to see first, optimize first. And then now if we really need it, then let's go hire the right person.
Yeah.
Amen. I made that mistake. For sure made that mistake.
All of us needs to make that mistake. It's part of
it. You actually have to.
You have to. Yeah.
It's part
Otherwise,
of the
you never learn. Like, how do you hire the right person?
Yeah. Oh, and if you're not consistently making mistakes, are you trying?
Yeah.
You know what I mean? Are you really
For sure.
trying? Are you
Mhm.
pushing for growth?
Yeah.
Yeah.
That's yeah. So Oscar, you actually gave me a huge mindset shift too. One of the times that you and I got together, we were at the Mindset Manor, and you talked to my wife
Mhm.
and I, and you were like, "Well, what does your revenue look like?" And I'm like, "Oh, we'll probably make $500,000. I'm gonna use random numbers here. $500,000 this
Mhm.
year." You're like, "Oh, okay, like revenue," and I was like, "Yeah." And you're like, "Hmm." You're like, "So what is that? Like one flip, two flips?" And I was like, no, no, no. We do a bunch of flip. We do like 20 flips
Mhm.
a year. He's like, oh, well, how inexpensive are those? And you started kind of breaking it down for me,
Yeah.
where I wasn't looking at the overall numbers because it does feel so much like a vanity number, like a fake number. But
Yeah.
when I finally dialed that back in, I was like, well, hold on. If I just look at the revenue, the cash coming in and out, and versus what I keep, well, then
Mhm.
yeah, I mean that number is huge, right? I'm like, because
Right.
now we have all of these houses, we
Totally
have all
irrelevant.
of we have all the property management, properties. I'm like, we're talking about hundreds and hundreds of thousands of dollars a month that are actually coming through. And you're like, okay, that's your revenue. How do you keep more of
Mhm.
that number? How do you increase margin from there? How do you, and I was like, I've never thought about it like this.
Yeah.
Yeah.
Yeah. I'm like, wow. Okay. Yeah. So if I do have $200,000 a month through this business coming through, but I only keep 10,000, how do I get that number to be 15 or 20,000? Because I wasn't looking at
Exactly.
it that way. I wasn't looking at it from the perspective of, okay, I guess I could charge more fees here. I could do a little bit more of this there. I could get this a little bit deeper here. And I wasn't seeing it as these levers that could be pulled, because to me, I'm like, that's a
Mhm.
make believe number. It's just money that passes through our account. You know what I mean? This is what we actually make. This is actually our
Yeah.
revenue.
Yeah, for sure. And that's a revelation to me too, and that all of that started with that revelation to say, okay, well, I gotta fix this first, right? And after a few years of doing that, now we can help people,
Yeah.
just
Yeah.
get that clarity too.
Yeah. I also see it as it's money that has potential.
Yeah.
Because if the money isn't there in the first place, then you don't have the potential there to go
Exactly.
get it.
Whereas
So,
we have that money there. And so for
yeah.
anybody listening to that has rental properties, think about it, right? Like if my average house, let's say, is $2,200 a month in rent, that is my revenue. I'm collecting $2,200. How do I keep more of that $2,200? Well, I'm going to have to reduce my debt. I'm going to have to figure out ways in
Yeah.
that sense, or I'm going to have to
Mhm.
increase rents. And now all
Yeah.
of a sudden you start to see this spread where you're like, wait a minute.
Yeah. I see 3 different ways, right?
Yeah.
You can refinance and lower your debt.
Mm-hmm.
You can increase rents,
Mm-hmm.
or you add value and services that they now can additionally pay for, right? Maybe now you have housekeeping services for them. And so you add a little bit on top of that. And now you're making the margin with that housekeeper, right? So there's all kinds of ways for sure.
Super cool.
Yeah. Yeah. Cool. Well, Oscar, this has been so great. And by the way, I got to shout out to your God is an Investor. Is that the actual brand, by the way?
Yeah. It's a brand that me and my daughter started. Yeah,
That's
Yeah.
so
for like I
cool.
think
I
it's been
love
2
it.
years now. Yeah, it's been a fun journey for us.
That's so cool. And so what's her website on that?
It's godisinvestor.co.
God is an investor.co.
Yep. Mhm.
Okay, cool.
Yeah, hopefully that pays for her college.
I
Yeah,
love
don't need
that.
to advertise my other businesses. I want to advertise that because then people will buy her products, and that money all goes to her college funds.
Well, I get it. You're just trying to maximize your margins.
For
If
sure,
you don't have
right?
to pay for college, hell yeah. So,
Yeah,
or heavens, yeah, I
exactly
should
right.
say.
Yeah,
So,
I don't I don't have to sell one rental every year to pay for her college.
Yeah, exactly.
very cool. So, Oscar, if people want to connect with you and see about you helping them get their books together, kind of like you've done with me, how do they reach out to you?
Our website is kpiadvisors.co.
Okay. kpiadvisors.co. Right on.
Yep.
Okay.
Yep.
And are you guys taking new clients?
We do right now. We do set a limitation of how many clients we can onboard every single month, just because we want to grow that organically. Last year, we hit a growing pain, right, where we onboarding a lot of clients, and then we have problem with the fulfillment department, like I said earlier, right? So now we fix our stuff and everything. We know our capability. Every single month we can onboard this many clients, right? So, but yeah, we're right now we're at about 3 to 4 clients a month, right? Before we were like, hey, let's onboard as many clients as we want, which is good, but that presents another problem with fulfillment. And I'm not really the type of people who just let's take as much and just figure it out, right? We will figure it out, but we have to figure it the right way.
I love it. You're methodical. And I think that
Yeah.
only serves to the customer service that you inevitably provide. So
Mhm.
Yeah.
Health
Mhm.
and
Yeah.
Health and I said hello. I love
Yeah,
her.
of course.
So
Yeah, we just
cool.
spoke to her today. So yeah.
Yeah, cool. Well, thanks so much, Oscar. You're gonna have to kind of gear up for us again because I feel like you will need to come back. There's a lot of good questions. We've got a lot
Yeah,
of great feedback from you.
of
And yeah,
course.
we would love to have you back. So
Oh yeah.
Absolutely.
cool.
Always great talking about finance. This is like one of those, like, it could be the most boring show, or it could be the most like fulfilling show that you have by the end of the year, because now you know what to do. You know where to look, right? Instead of like, oh,
Oh,
I'm gonna buy like 5 more houses next year. Well,
Yeah.
I better look at my balance sheet first.
Yeah. Balance sheet. Right on. Cool. Well, guys, thank you so much for coming to our Explain It podcast. Stephen and I love when you guys are here every week. We remind you that we are here on Wednesday, 1 p.m. to 2 p.m. Arizona time every week, and we look forward to seeing you. However, next week is Christmas.
We will not be here next week, guys. Sorry.
So we will catch you guys in the new year. We really appreciate you. Hopefully you guys are spending time with your family, your loved ones, with your bookkeepers, and as you gear up for 2025. We really appreciate you, and we can't wait until providing more value in 2025. So thanks, everybody.
Until next year.
Awesome. Thank you.
Awesome.